Gold just crossed $5,000. Silver hit triple digits before crashing back down. And everyone's screaming the same word, bubble. But what if I told you? This isn't a bubble at all. What if this is something far more dangerous? Something the establishment desperately needs you to ignore. See, while everyone's watching these prices spike, they're missing what's really happening. The currency system itself is breaking. Not crashing overnight, but dying slowly. Then all at once. And the scary part? We're still early. Welcome to Currency Archive, where we decode the financial signals the mainstream conveniently forgets to mention. Now, if you've made it this far, you're clearly someone who values truth over comfort. So do me a favor, friend. Hit that subscribe button like you'd underline an important passage in a history book. Because what we're documenting here, it's history in real time. And tell me in the comments, where in the world are you watching this from? Let's see how global this awakening really is. Gold crossed $5,000 per ounce. Silver briefly touched triple digits before retreating. And across trading floors, financial media platforms, and investment forums, the same word appeared everywhere. Bubble. The business community watches these price movements with deep skepticism. Aspiring entrepreneurs scroll past headlines warning of imminent collapse. Young investors, trained on stories of tulip mania and dot-com crashes, see only one thing: dangerous speculation reaching its peak. But they are making a fundamental error. They are diagnosing the symptom while missing the disease entirely. Consider what defines an actual bubble. Tulip mania in 1637. Netherlands saw ordinary citizens abandoning productive work to trade flower contracts. The dot-com era witnessed companies with zero revenue commanding billion-dollar valuations. The 2008 housing crisis involved mortgage securities so disconnected from underlying asset quality that institutional investors could not identify actual risk. Each bubble shared common characteristics: euphoric retail participation, valuations completely detached from fundamentals, universal belief that traditional metrics no longer applied, and most critically, the asset itself was the source of mania. Now examine current precious metals markets. Retail participation remains historically low. Surveys show public ownership of physical gold and silver sits near multi-decade lows. The average citizen cannot identify current gold prices within $500. Social media trends do not feature precious metals. No celebrities promote gold investments. No late-night television commercials promise overnight riches from silver speculation. Institutional positioning tells a different story entirely. Central banks purchased over 1,000 tons of gold in recent years. Sovereign wealth funds quietly accumulated physical metal. Insurance companies adjusted portfolio allocations toward hard assets. These institutions do not chase bubbles. They respond to structural risks. The critical difference becomes clear when one asks a simple question: what is actually moving? In tulip mania, tulips moved. In the dot-com bubble, technology stocks moved. In the housing crisis, real estate prices moved. But in this moment, currency systems are moving. Gold is not rising. The dollar is falling. Silver is not surging. Fiat measurement systems are failing. The price changes reflect not speculation in metals, but dysfunction in the monetary framework used to measure value itself. This distinction matters enormously. When an asset bubble bursts, the asset returns to fundamental value. When a currency system breaks, there is no fundamental value to return to. The measuring stick itself has failed. History provides clear examples. Weimar Germany citizens who held physical assets survived hyperinflation. Those who trusted paper marks lost everything, not because they failed to time the market correctly, because the market they trusted ceased to function entirely. Zimbabwe experienced the same pattern. Venezuela repeated it. Argentina continues demonstrating it. The sequence never changes: gradual currency debasement, growing public distrust, accelerating breakdown, then collapse. And in every case, those who positioned early appeared premature. They endured years of criticism. Friends called them paranoid. Financial advisors labeled them irrational. Mainstream analysts mocked their concerns. Until the system broke, then premature became prescient. But by that moment, positioning opportunities had vanished. This explains why current observers miss what is actually occurring. They apply bubble psychology to a currency crisis. They use asset valuation metrics to measure monetary system failure. They expect gold and silver to crash back to reality, not understanding that reality itself is being repriced. The business community faces a choice: accept mainstream narrative that dismisses precious metals movement as speculative mania, or examine underlying data showing systematic currency debasement, unsustainable debt trajectories, and accelerating central bank balance sheet expansion. One perspective requires no analysis. Simply repeat what financial media provides: comfortable, safe, consensus. The other perspective demands uncomfortable questions. What happens when sovereign debt exceeds any mathematical possibility of repayment? How do fiat currencies maintain value when creation rates exponentially exceed economic growth? Why do Eastern central banks accumulate physical gold while Western institutions maintain paper pricing mechanisms? These questions do not have comfortable answers, but they have historically consistent patterns. And those patterns suggest something far more significant than a bubble reaching its peak. They suggest a currency system reaching its breaking point. The difference between these two interpretations determines everything. Because if this is a bubble, then selling makes sense. Wait for the crash, buy back lower. Standard speculation strategy. But if this is a currency crisis, then the concept of lower becomes meaningless. Lower in what? A dollar losing purchasing power? A euro facing structural challenges? A yen printed without restraint? The measuring stick itself is failing. And that reality, that fundamental breakdown of monetary measurement, is what happens next. August 15th, 1971. A Sunday evening television broadcast changed the architecture of global money forever. President Nixon announced the United States would no longer convert dollars to gold at $35 per ounce. The Bretton Woods system, the framework that governed international monetary order since 1944, ended in a single declaration. What followed was not immediate chaos. It was something far more dangerous, gradual, incremental, almost invisible at first. The removal of gold convertibility eliminated the final restraint on currency creation. For the first time in human history, the world's reserve currency became a pure debt instrument backed by nothing except governmental promise. No commodity, no fixed supply, no external limitation. The consequences took decades to manifest, and they are manifesting now. Consider the mathematics that cannot be avoided. In 1971, total U.S. federal debt stood at approximately $400 billion. Today, that figure exceeds $34 trillion, an 85-fold increase. During the same period, GDP grew roughly 20-fold. Debt expanded 4 times faster than economic output. This gap represents something critical. It shows currency creation detached from productive value creation. Money supply grew not because economies produced more goods and services, but because governments needed to finance expenditures they could not fund through taxation or legitimate growth. The pattern repeats across every major economy. Japan's debt to GDP ratio exceeds 260%. Italy approaches 140%. France, Spain, and the United Kingdom all carry debt levels that would have been considered catastrophic just 2 decades ago. Even Germany, historically conservative in fiscal matters, has abandoned balanced budget principles. But raw debt numbers tell only part of the story. The true fracture appears in central bank balance sheets. The Federal Reserve's balance sheet stood at roughly $900 billion in 2008. By 2022, it exceeded $8 trillion. The European Central Bank followed identical trajectory. Bank of Japan expanded even more aggressively. People's Bank of China created credit at rates that make Western expansion appear modest. These are not temporary emergency measures. They represent permanent structural dependency. Modern economies now require continuous central bank intervention to function. When the Federal Reserve attempted modest balance sheet reduction in 2018, markets immediately destabilized. Repo market seizures in 2019 forced immediate liquidity injection. The 2020 crisis triggered the largest monetary expansion in recorded history. Each intervention becomes larger. Each crisis requires more aggressive response. Each temporary measure becomes permanent policy. This creates a mathematical inevitability. Currency debasement must accelerate. The mechanism is straightforward. Government debt reaches levels that cannot be serviced through tax revenue or economic growth. 2 options remain: default explicitly or default implicitly through inflation. Every government in history has chosen the second option. Inflation allows debt repayment in devalued currency units. A government borrowing $1 trillion today can repay that trillion in 20 years using currency units worth a fraction of original purchasing power. The debt disappears nominally while being destroyed in real terms. But this strategy requires continuous currency creation. And continuous currency creation produces exactly what observers see in gold and silver markets today. Not speculation, not mania, not bubble psychology. Repricing. Assets with fixed supply characteristics respond to unlimited currency creation by adjusting price in currency terms. Gold does not change. An ounce of gold remains an ounce of gold. But the number of currency units required to purchase that ounce increases as currency supply expands. This explains why gold systematically outperformed virtually every asset class since 1971. Not because gold produces yield, not because gold generates cash flow, not because gold represents innovative technology or productive enterprise, because gold maintains scarcity while currencies abandon it. The historical pattern appears with remarkable consistency. Weimar Germany began with modest inflation in 1914. By 1923, prices doubled every few days. Zimbabwe started with manageable deficits in the 1990s. By 2008, inflation reached billions of percent annually. Venezuela maintained relative stability until 2014. Within 5 years, the bolivar became worthless. Each case followed identical sequence. Gradual debt accumulation, growing deficits requiring monetary financing, accelerating currency creation, loss of public confidence, breakdown of price stability, hyperinflationary collapse. The timeline varied, the severity differed, but the pattern never changed. And that pattern is what makes current environment so concerning. Because every structural indicator present in historical currency collapses exists today in the global monetary system. Unsustainable debt trajectories, central banks monetizing government deficits, negative real interest rates punishing savers, financial repression transferring wealth from creditors to debtors, and most critically, complete abandonment of any external monetary restraint. The gold price is not predicting future collapse. It is reflecting present reality. A currency system built on infinite debt expansion cannot maintain stable value indefinitely. The mathematics simply do not work. Every additional trillion in debt, every expansion of central bank balance sheets, every suppression of interest rates below inflation, each action further weakens the foundation. And weakening foundations eventually fail. Not necessarily tomorrow, not through sudden dramatic collapse, but through accelerating deterioration that reaches a point where confidence breaks completely. That point has not arrived yet, which is precisely why current positioning is premature rather than late. Something unusual appeared in global metal markets during 2023, a price gap that should not exist. Silver traded at $77 per ounce in New York. The same metal, the exact same commodity, commanded $86 in Shanghai, a $9 premium, nearly 12% difference. Standard economic theory says this cannot persist. Arbitrage should close the gap immediately. Traders should buy in New York, sell in Shanghai, pocket the difference. The price differential should disappear within hours, days at most. But it did not disappear. It widened. The seemingly technical market anomaly reveals something far more significant than a temporary pricing inefficiency. It exposes a fundamental fracture in the global monetary system, a fracture that divides the world into two distinct economic camps with incompatible strategies. The West maintains paper markets. The East accumulates physical metal. Understanding this divergence requires examining what actually trades in each market. COMEX in New York operates primarily through futures contracts, paper instruments representing claims on metal. For every 100 ounces of paper silver traded, approximately 1 physical ounce exists in deliverable inventory. The system functions through leverage. Most contracts settle financially rather than through physical delivery. This structure serves a specific purpose. It allows price discovery without requiring actual metal movement. Banks can hedge exposure. Miners can lock in future sales. Investors can gain price exposure without storage costs. The market operates efficiently, as long as participants accept paper claims as equivalent to physical metal, but Shanghai operates differently. The Shanghai Gold Exchange and Shanghai Futures Exchange emphasize physical settlement. Contracts require actual metal delivery. Warehouses stock substantial physical inventory. Participants expect to receive actual gold and silver, not cash settlement. This fundamental structural difference creates the premium, because physical metal is becoming increasingly difficult to obtain. Central bank purchasing data tells the story clearly. China's official gold reserves increased from approximately 1,000 tons in 2015 to over 2,000 tons today. But multiple analysts believe actual holdings far exceed reported figures. Chinese central bank purchases concentrate in physical metal, not paper derivatives. Russia followed similar pattern before Western sanctions. Systematic accumulation, physical delivery, storage in domestic vaults. By 2022, Russian gold reserves exceeded 2,300 tons, making it the 5th largest official holder globally. India, Turkey, Poland, Czech Republic, Hungary, Singapore. The list of central banks purchasing physical gold expanded dramatically after 2018. The pattern is unmistakable. Eastern and non-Western central banks are converting foreign exchange reserves from dollars and euros into physical precious metals, not as speculation, not as investment, not as strategic monetary reserve reallocation. They are preparing for a different monetary system. This preparation accelerated after specific geopolitical events. In 2022, Western governments froze Russian central bank reserves held in dollars and euros. Approximately $300 billion became inaccessible overnight, not through default, not through debt restructuring, through unilateral political decision. The message to every non-Western central bank was clear. Reserves held in Western currency systems are not truly reserves. They are conditional deposits subject to political seizure. Physical gold stored in domestic vaults cannot be frozen, cannot be sanctioned, cannot be confiscated remotely. It represents genuine reserve asset outside Western financial control. The strategic shift became obvious in subsequent months. Saudi Arabia began accepting yuan for oil transactions. Brazil and China established bilateral trade settlement in local currencies. BRICS nations announced development of alternative payment systems. United Arab Emirates purchased substantial gold quantities. Each action reduced dollar dependency. Each transaction bypassed Western financial infrastructure. Each choice reflected growing distrust of reserve currency framework controlled by Western governments, and each decision increased demand for physical metal as alternative reserve asset. This creates the Shanghai premium. Physical metal flows east. Eastern buyers pay premium prices because they want actual metal, not paper promises. Western markets maintain lower prices through paper contract leverage, but that leverage depends on participants accepting cash settlement. What happens when Eastern demand for physical delivery exceeds Western willingness to deliver actual metal? History provides precedent. The London Gold Pool operated from 1961 to 1968. 8 central banks collaborated to maintain gold price at $35 per ounce by selling physical gold whenever price pressured upward. The strategy worked for 7 years. Then France demanded physical delivery of dollar reserves. The pool collapsed in March 1968. Within 3 years, Nixon ended gold convertibility entirely. The system could not survive sustained demand for physical delivery at artificial prices. Current environment shows disturbing parallels. Western institutions maintain paper gold and silver prices through futures market leverage. Eastern buyers demand physical delivery at premium prices. The gap widens rather than closes. Physical inventory in Western vaults declines steadily. COMEX silver inventories dropped from peak levels above 400 million ounces to current levels fluctuating around 250 million ounces. Registered inventory available for immediate delivery sometimes falls below 50 million ounces, yet open interest in paper contracts represents claims on over 1 billion ounces. The mathematics become concerning. If even 10% of paper contract holders demanded physical delivery simultaneously, available inventory could not satisfy demand. Cash settlement would become forced settlement, and forced cash settlement reveals paper claims are not equivalent to physical metal. That revelation would shatter the pricing mechanism entirely. Eastern buyers understand this vulnerability, which is why they pay premiums, why they accept higher prices, why they prioritize physical delivery over paper efficiency. They are not speculating on price movement, they are securing position before the system fractures completely. Because once the fracture becomes obvious, once Western paper markets lose pricing credibility, once physical premiums explode beyond arbitrage possibility, the opportunity to convert paper wealth into physical assets disappears. Shanghai premium is not market inefficiency. It is early warning signal, a signal that two incompatible monetary visions are separating. Western faith in paper instruments backed by institutional promises. Eastern preference for physical assets beyond political control. One system depends on confidence, the other depends on tangibility. And when confidence fails, tangibility is all that remains. The wealthiest families in Europe own vineyards that produce no profit, ancient estates, prime real estate, operating costs that exceed revenue by substantial margins year after year. Financial advisors regularly suggest selling these properties, investing proceeds in higher yield assets, maximizing return on capital. The families refuse, because they understand something fundamental about wealth preservation across generations. Strategic assets are not measured by quarterly returns. Those vineyards survived the Napoleonic Wars, persisted through World War I, endured World War II, weathered the Cold War. The families that owned them preserved wealth not by chasing yield, but by holding tangible assets that retained value regardless of which government ruled, which currency circulated, or which financial system collapsed. This principle applies directly to current precious metals positioning. The business community faces a choice that will define the next decade. Treat gold and silver as speculative trades to be timed perfectly, or recognize them as strategic insurance against monetary system failure. These are fundamentally different approaches. Speculation requires predicting exact timing, identifying peak prices, executing perfect entry and exit. It demands being right about short-term market psychology, about trader sentiment, about technical chart patterns. Strategic positioning requires different thinking entirely. It asks a single question: what preserves purchasing power if the monetary system undergoes severe stress or complete restructuring? History answers this question with remarkable consistency. During every major currency crisis, monetary transition, or systemic breakdown, physical precious metals preserved wealth, not because gold and silver produced returns, because they maintained value while paper instruments failed. Consider the practical mathematics. An entrepreneur holds $1 million in cash and bonds. If inflation averages 8% annually for 10 years, the purchasing power declines to approximately 46% of original value. The nominal $1 million remains, but it purchases less than half what it once did. Now consider the same entrepreneur allocating 20% to physical precious metals. If metals simply maintain purchasing power while currency devalues, The $200,000 position becomes worth significantly more in nominal currency terms, not because metals gained intrinsic value, because the currency lost it. This is not speculation. This is structural hedge against predictable monetary debasement. The business community often misunderstands this distinction because traditional financial education emphasizes different metrics: return on investment, yield generation, capital appreciation. These metrics work well in stable monetary environments. The current environment is not stable. Sovereign debt exceeds mathematical possibility of repayment through growth or taxation. Central banks maintain balance sheets at levels previously considered emergency measures. Real interest rates remain negative across most developed economies. Currency creation continues at rates disconnected from productive output. These are not temporary anomalies. They are permanent structural features of post-1971 monetary system reaching terminal phase. And terminal phases create binary outcomes. Either governments find politically acceptable path to reducing debt through growth and austerity, or they reduce debt through inflation and currency debasement. History shows the second path gets chosen with near-perfect consistency, because the first path requires pain today, the second path delays pain until tomorrow. Politicians always choose tomorrow. This creates the strategic framework. Being premature and positioning for monetary transition carries specific costs: opportunity cost of capital allocated to non-yielding assets, social cost of appearing paranoid or irrational, psychological cost of watching others profit from risk assets during bubble phases. But being late carries catastrophic costs. When currency crisis becomes obvious, when monetary transition begins in earnest, when public rushes to preserve purchasing power, physical precious metals become unavailable at any price. Premiums explode. Delivery timelines extend to months. Dealers run out of inventory. The 2020 experience demonstrated this clearly. When pandemic fears triggered flight to safety, physical gold and silver premiums spiked to 30% above spot price. Dealers sold out completely. Mints could not produce coins fast enough. Buyers willing to pay any price could not obtain metal. That was temporary crisis resolved through monetary expansion. Imagine sustained crisis where monetary expansion itself becomes the problem. The window for positioning closes completely. This is why wealthy families buy vineyards that lose money, why endowments hold farmland that underperforms equities, why sovereign wealth funds accumulate physical assets despite negative yields. They're not trying to maximize quarterly returns. They are ensuring survival through whatever comes next. The young entrepreneur building a business must think in these terms, not abandoning growth strategies, not liquidating productive assets, not surrendering to fatalism, but recognizing that all business success, all wealth accumulation, all financial planning depends on the monetary system functioning reliably. And if that system fractures, nothing else matters. A successful company generating millions in revenue means nothing if the currency measuring that revenue collapses. A diversified portfolio of stocks and bonds provides no protection if the financial system undergoes forced restructuring. Digital wealth stored in banking systems offers no security if those systems become subject to capital controls or confiscation. Physical precious metals represent the insurance policy nobody wants to buy, until they need it. And by the time need becomes obvious, the policy is no longer available. This is what premature actually means in strategic context. It means paying insurance premium before the crisis, accepting opportunity cost today to preserve optionality tomorrow, looking foolish during bubble phases to maintain survival capacity during collapse phases. The European families with unprofitable vineyards endured centuries of criticism. They were called backward, inefficient, sentimental, financially illiterate. Until wars came, currencies collapsed, governments fell, financial systems restructured. Then those tangible assets proved their worth. The business community stands at similar juncture today. Gold crossing $5,000 is not a peak. It is a warning. Silver touching triple digits before retreating is not a bubble bursting. It is a system malfunctioning. The choice is whether to recognize the warning or dismiss it as noise, whether to position strategically or optimize tactically, whether to preserve wealth across potential transition or maximize returns during current cycle. There is no perfect answer. But history suggests strongly that being premature beats being late, because when monetary systems fail, there are only two groups: those who positioned early and endured criticism, and those who understood too late and lost everything. The currency crisis is not coming. It is already here, unfolding incrementally, accelerating gradually, building pressure systematically, until the moment it breaks exponentially. And that moment rewards those who prepared prematurely, while punishing those who waited for certainty. Certainty arrives only when opportunity has vanished. Strategic positioning happens in uncertainty. That is why we are not at peak gold. We are early. And early, in systemic transitions, is exactly where survival begins.